You open the app and everything is green, your portfolio is up. The market has been doing what you wanted it to do, and on paper things look pretty good. And yet, there it is, that feeling sitting just underneath the surface that you cannot quite name and cannot quite dismiss. It is not panic, it is not even worry exactly. It is more like a background hum. The kind of low-frequency unease that follows you out of the app and into the rest of your day because somewhere between the green numbers and the headlines you have been half reading and the conversations you have been overhearing, something in your gut is quietly telling you that this does not feel stable. You have seen the words, overvalued, bubble, correction incoming, historic highs. And the rational part of your brain says maybe it is fine, maybe the headlines are always saying something like this, maybe you are overthinking it. But the other part of your brain, the part that remembers 2008, the part that remembers how fast things moved when things started moving, that part will not fully relax. And here is what I want to tell you right now before we go any further. That hum is not irrational, that hum is data. It is your financial instincts registering something real, which is that markets do not go up forever, that corrections and crashes are not anomalies, they are built into the system, they are how the system breathes, and the question was never whether one would come. The question has always only ever been whether you would be prepared when it did. And most people are not because they are unintelligent, but because nobody ever taught them the difference between structural preparation and emotional reactivity. And that difference is exactly what today's video is about. If this is your first time here, hit subscribe right now, because every week on this channel we go deeper than the surface level financial advice that tells you what to do without ever explaining why your brain fights you every step of the way. I'm David Marshall, and I have spent over a decade studying the psychology underneath investment decisions, the gap between what people know they should do and what they actually do when things get hard. And the crash preparation conversation is one of the most psychologically loaded conversations in all of personal finance. So stay with me, because what I am about to share is not a prediction. I cannot tell you when the crash is coming. Nobody can. What I can tell you is what smart investors are doing right now while everything is still green and calm and the options are still theirs to choose. I want you to picture two neighbors, same street, same forecast for a massive snowstorm hitting in 72 hours. The first neighbor sees the forecast and thinks, yeah, probably won't be that bad, and goes about their week. The storm hits Thursday night. Friday morning they're outside in the cold, car buried, no salt, no shovel they can find, scrambling to get somewhere they needed to be, and every decision they make is reactive, rushed, and expensive in one way or another. The second neighbor saw the exact same forecast on Tuesday and made one quiet trip to the store. Salt, shovel by the door, extra groceries, generator checked. Friday morning they wake up, look out the window, make coffee, and let the storm do what it is going to do. Same storm, same street, completely different experience. Not because the second neighbor is smarter or luckier, but because they did one thing differently. They prepared while preparing was still calm and cheap and optional. That is structural preparation. And that is exactly what separates the investors who come through a market crash with their wealth intact, sometimes even better off, from the ones who spend months just trying to recover the ground they lost in a panic. So let me get specific, because this is where most financial content goes vague, and I am not going to do that to you. The first thing I want you to do right now before the market does anything at all is answer one very honest question. And I need you to answer it not with your rational brain, not with the version of yourself that reads financial planning articles, but with your gut. Here it is. What is the dollar amount that would make you panic sell, not theoretically, viscerally? What is the number on your portfolio screen that would make your stomach drop, your hands do something with your phone before your brain caught up? The number that would make you feel like you needed to do something right now to stop the bleeding. Is it a 10% loss? Is it 20? Is it a specific dollar figure, 100,000 down, 200,000? What is the number that breaks your discipline? I call this your panic threshold. And knowing it is one of the most valuable pieces of financial self-knowledge you can have. Because here is what happens during a real crash. It does not happen slowly and politely. It happens fast, and it happens ugly, and it is accompanied by a media environment that is specifically designed to make you feel like acting immediately is the responsible thing to do. And the investors who blow up their own portfolios during crashes are almost never the ones who had bad strategies. They are the ones who had strategies built for more risk than their panic threshold could actually tolerate. They had an aggressive growth portfolio and a conservative nervous system, and nobody ever helped them reconcile those two things. So when the drop came, they sold, they locked in the loss, they stepped out of the market, and then the market recovered without them and they missed it. That is how ordinary people lose extraordinary amounts of money. Not from the crash itself, but from the sell-off they initiated at the bottom, because they were not emotionally built for what they were financially positioned in. So if your honest answer to the panic threshold question reveals that you cannot really stomach a 30% drawdown without making a decision you would regret, that information should reshape your portfolio today, not after the crash, today. While you still have the calm and the options and the time to make it a deliberate choice rather than a reactive one. Now let us talk about something that most investors chronically underestimate. Cash, not as a failure to be invested, not as money sitting on the sidelines doing nothing. Cash is optionality, cash is dry powder. Here is the reframe I want you to hold on to. During a market crash, almost everyone is in survival mode. They are watching their portfolio drop and they are trying to stop the bleeding. They are not thinking about opportunity, they are thinking about loss. But the investors who build real long-term wealth through market cycles are the ones who show up to a crash with cash available and a plan to use it. Because when the market drops 30 or 40%, the assets that were overpriced 6 months ago are now on sale. The companies that were genuinely good businesses before the crash are still genuinely good businesses. The difference is now you can buy them at a significant discount, but you can only buy them if you have something to buy them with. Cash right now, parked in a high-yield savings account earning a real return while you wait, is not laziness. It is preparation. It is the financial equivalent of having the shovel by the door before the storm. It means that when everyone else is just trying to survive the crash, you are in a completely different position. You are shopping. And the investors who are shopping during a crash while others are panicking are the ones who look like geniuses 3 years later. Not because they timed anything perfectly, but because they had liquidity when liquidity was the most valuable thing in the room. How much cash is the right amount? That depends on your situation, but a reasonable starting point for most people is somewhere between 6 months and 1 year of living expenses sitting somewhere accessible and stable. Not invested, not at risk, just there, patient, waiting for you to need it either as a personal safety net or as an opportunity fund or both. And the time to build that position is right now while the market is calm and moving some money to cash does not feel urgent or painful. Because when things start dropping, the psychological cost of moving to cash skyrockets. You feel like you're selling at a loss. You feel like you're making it worse. You want to hold on and hope. The time to make calm, rational positioning decisions is before the emotion enters the room, not after. Now here is the piece that almost nobody in financial content talks about, and I think it is honestly the most powerful lever you have going into any market downturn. It is not your portfolio allocation. It is your income. Your ability to generate income is a more powerful force than your portfolio in a crash environment. Here is why. If your only financial engine during a crash is your portfolio, a down market forces you to either draw from a shrinking pool, locking in losses, or to stop spending entirely, which has its own quality of life cost. But if you have a second source of income, even a modest one, a freelance skill you can offer, a small side income from something you are already good at, rental income, consulting, literally anything that generates real dollars that are not dependent on market performance, that income completely changes your relationship to the crash. You do not need to touch the portfolio. You can let it sit. You can actually contribute to it while it is down. You become one of the people buying the dip instead of one of the people surviving it. And this is not about becoming an entrepreneur if that is not who you are. It is about asking yourself a very honest question right now while things are calm. If my income dropped by 30% tomorrow, what could I do? What skill do I have that someone would pay me for outside of my current job? What asset do I already own that could generate some income if I needed it to? What door could I open that is currently closed simply because I have not needed to open it? The crash will not announce itself. It will not give you a month to prepare, but right now you have time. And time is the only resource that a crash cannot take from you once it has already arrived. Let me bring this all together because I want you to leave this video with something you can actually act on today. Smart investors are not the ones with the best predictions. They are the ones with the best preparation. They know their panic threshold and have aligned their risk exposure to match their actual nervous system, not their idealized disciplined self. They hold cash not as a retreat from investing, but as dry powder that turns a crash from a threat into an opportunity. They are quietly building or protecting a second income stream so that a portfolio downturn does not force their hand. And they are making these structural moves right now while everything is still green and calm, and the choices are still theirs to make with clear heads. The background hum you feel when the market is at all-time highs, and the headlines are getting louder is not anxiety you need to suppress. It is a signal you need to act on, not by selling everything, not by going to cash on everything, but by taking honest stock of whether your current setup is built for you, for your real risk tolerance, for your actual life circumstances, for the version of yourself that will exist on the morning when everything is suddenly red. People talk about crash-proofing a portfolio like it is some complicated technical achievement. But the investors I have watched navigate downturns with the most grace and the most long-term success, they all describe something that sounds much simpler than a strategy. They describe feeling like they had room, like they had options. Like the market doing something terrible was not the same as their life doing something terrible because they had built enough buffer between those two things. That buffer is what we are building here, not dramatic wealth, not a perfect prediction, just room, oxygen, the ability to take a breath when everyone around you is holding theirs. If this video shifted something in how you're thinking about what is ahead, subscribe to David Marshall Finance right now because this is exactly the kind of conversation we have every week on this channel. Like this video if it gave you something real. And tell me in the comments what is one thing you're doing right now to prepare. I read every comment and I genuinely want to know where your head is at. I will see you in the next one.